Thank you very much for joining us. We are money254.co.ke, a website that is helping Kenyans to compare and apply for loans, savings accounts, and other financial products in the Kenyan market. We are going to be commencing our presentation on why are so many Kenyans taking logbook loans today as compared to a couple of years ago. And we're going to take you through a couple of things about choosing the right loan depending on your circumstances, and when is it the right time, or in what situations is taking a logbook loan most ideal. My name is Eric Ndubi. I am the managing editor here at Money254, and I'm with my colleague.
Hello, hi. My name is Hilda. I'm the commercial analyst at money254.co.ke, and like Eric mentioned, we are Kenya's premier financial marketplace that helps people to compare and apply for loans online.
Indeed. As more on money254.co.ke, if you're only hearing about us for the first time, we help people compare and apply for loans online and other financial products. These include you can apply and compare and apply for business loans, personal loans, logbook loans, car financing today on money254.co.ke. And as well, you can apply, compare and apply for credit cards, current accounts, savings accounts, and very soon you'll be able to compare and apply for auto insurance on money254.co.ke. Today, we are going to talk a little about who we are, and then next we are going to discuss a section on finding the right loan for your specific needs. Before then, we move on to logbook loans and how to why so many Kenyans are taking them, and how to actually compare and find the logbook loan that best meets your financial circumstances.
So we combine financial literacy to help people learn more on financial products, so that when they are comparing products, they know on the product's details to use to do the comparison. So we have a very strong financial content arm led by Eric here that writes very many articles on financial literacy, personal money management, and also we provide or we record some videos that you must have come across here on TikTok. So we now then help equip Kenyans on the information that they need to be looking out for when they are looking for financial products. And finally, once someone has compared, we help them apply for the said products.
Indeed. Since our launch in April 2021, over 3 million unique users have used money254.co.ke to compare over 270,000 financial products instances of comparison, which is helping those who compare to make their decisions with so much more confidence. Now, on finding the right loan for your specific need, one of the major challenges that many borrowers face is mismatching their need for loan money and the loan product that they loan product. You may be well aware there are multiple types of loans that are available in the Kenyan market, from the Shylock to digital loans to logbook loans and everything in between, SACCOs, microfinance institutions, microfinance banks, commercial banks. There are loads of loan options available for you, but every time you need a loan, you have a very specific situation that you need that loan to solve for you. So if you are not able to match the need for your loan, the reason why you need a loan with the loan product that best fits that need, then you may find yourself taking a loan that you do not need, and this could be the beginnings of digging yourself into a financial hole. So while we're going to go deeper into why Kenyans are taking logbook loans in droves, we want to first discuss some of the most important factors to consider when the moment you think you need a loan. How do you know which loan type that you should apply for? And we have found these 4 factors to be the most important ones.
I would say that is quite true. So the first factor would be the use case. Like Eric said, when you're looking for a product or for a loan, you have a specific need in mind. So is it a personal need or is it a business need? If it's a business need, is this going to an existing business, or is it going to start in a business? Is it going to expand in a business? So this will help you learn or narrow down the proper loan category to go out for. The second factor would be the amount needed. So if you need to determine the loan categories that
the loan categories that can realistically get you the amount that you're looking for. So if, for example, you're looking for 10,000, somebody else is looking for 1.5 million, then the loan category is different. Even if somebody is looking for 10,000, 50,000, 120,000, the loan categories will keep changing as your amount changes. So you consider the amount you need, because and the amount you need will also be determined by other factors. You might want to get a loan of 200,000, but you have other existing loans. And this means that some lenders will only lend you if you probably are not already servicing another loan. Other lenders will have more accommodative eligibility criteria, and they may be more flexible. Also, about the amount you need, the return on investment that you're anticipating is an important factor, because ideally the loan should pay for itself. If it's, for example, to fund a transaction, is the amount you're going to get from the loan categories that you're narrowing down to sufficient enough to fund that operation that you need profitably, such that the loan can pay itself. So the amount you need then will also help you to narrow down on what loan categories you need to be looking at.
So another factor you should look at is the speed. The speed is how urgent you need the money. Is this something you need today or maybe next week? So you look at the turnaround time, or how long it will take for the institution to do the approval process and disperse the amount to your account. And also so this will help you know which lender to prioritize depending on the turnaround time. And the last factor would be the duration. How long do you want to repay the loan for? So this will now be tied back to the investment, or what you are needing, or what you are putting the money into. Because ideally, you want to take money that will then, when you invest that money, it will then pay itself back. So if you're taking the loan for 1 month, 1 month loan, and where you are investing the money, the returns will be coming in after 3 months, then that means that for this 1 month, when your amount will be due, you'll have to dip into your pockets to repay the loan. So the duration for the loan will determine which loan category you need to prioritize.
Also tied to the duration is also the cost of monthly repayment. Typically, if you take a big loan amount, but you take it for a short duration, it means you will pay higher monthly amounts. So you have to factor in the loan categories that allow you to take the duration that will allow you to pay your loan comfortably. And we find a lot of people then fall into problems by mismatching the loan need with the wrong category. And we are going to show you in 4 examples next how taking the wrong loan category could impact your finances.
Yeah, so I think that is a very important point for our followers. If you take a long-term loan to solve for a short-term problem, you're then left with the burden of the loan. I took the loan maybe to pay, say, for rent, unfortunately, and I took a 10-month loan. I paid the rent for 1 month. I have 9 months to service the loan that I utilized on the first 1 month. So that would mean the loan will have higher cost, because the longer the loan, the more expensive it is. And another thing is that should I find money early enough, there might be restrictions on whether I can repay the loan early. And if I repay early, will I save on interest? So there might be restrictions on that.
Right.
Yeah.
Another example of taking a long-term loan for a short-term need is, for example, if you're a business and you take a loan to buy stock or to pay your employees' salaries for that month, but you take a 12-month loan to pay this month's salaries for your employees, then you have this long-term loan that only has solved a short-term need, but the need to repay the loan remains. And the problem that caused you to need that money probably has not been solved.
Yeah.
Second example of a mismatch between the loan need and the product category is taking a short-term loan to fund a long-term business investment. For example, if you're opening a new branch, then you take a 3-month loan when typically the branch will start making profit after 6 months, for example. Or taking a 2-month loan for to fund, to buy like a big business asset that will take much longer to start paying itself. What this means then, you have taken the wrong product category. You should have taken a long-term loan to fund a long-term need. The potential issues there is that it may be very difficult for your business to pay for the loan.
Yeah.
And typically then you may be forced to dip into the business cash flow or indeed into your personal savings to service this loan, since you have mismatched the loan and the reason for taking the loan.
Okay. So another mismatch would be when you take a medium-term loan with frequent repayments. So this is maybe you take a loan and you need to, say a 6-month loan, and you need to make bi-weekly repayment. And ideally your business only brings in say enough money after a cycle of 4 weeks. So this would mean that you are struggling to meet the scheduled repayments, which then could lead to you either now dipping into your working capital or your cash reserve to pay for the amount. This could also, another problem that could arise with this is that you might then miss payments. Then when you miss payments, lenders will penalize you. So this then increases the cost of the loan.
Right. Another example of mismatching the reason for taking loan and the loan category to solve that problem is a common thing which is typically called loan stacking, where you're taking several small loans such as digital loans or overdraft to raise the total amount you need for when you're low on cash. Say, for example, it's the 20th of the month and you have a big need for, like, say 50,000, and you qualify for 5,000, 10,000 here, an overdraft of 5K. You decide to take those small loans to add up to 50,000 and solve your problem. Now, the potential challenges are you have, let's say, 5 loans of 10K each that you need to repay with different lenders, different payment schedules. Juggling multiple repayment schedules can be very challenging for most people. And usually, the fact that you have taken small loans across many lenders means that the total cost of credit will typically, probably as actually guaranteed, that the cost of many small loans as compared to taking one loan to do that need will typically be much higher. So you can see, understanding these major factors that help you match the need for money with the right loan category can help you save money and even have an easy time servicing your loan and solving the problem that you needed to solve with these loan amounts.
Okay. So ideally, we'll give examples on the types of loans, categories, and also the use case that you can use that for. So if you're looking for a large business investment, so you're buying a huge asset, you want to expand, you want to start a new line of business, For this, where the return is guaranteed later on, it's ideally recommended you take a long-term product from, say, a bank, whether unsecured or secured, or from a microfinance institution, whether secured, such as a logbook loan or a title deed loan.
Or a SACCO.
Or a SACCO, yes.
The other use case and the ideal product category is the reason why you need a loan is for working capital needs. So you probably usually want to keep restocking every month or every other week. Then some of the ideal product categories for such kind of a need is they are unsecured working capital loans that are tailored for that specific need. You could also get credit cards for personal needs if sometimes, like that example we just gave of you run your salary, your reserves running out on the 20th of the month, and you usually paid on the 27th, for example. Then you can take a credit card for personal needs. Then the credit card would give you 50 days of free, at least 50 days of interest-free duration, so that then you can continue solving the problems that occur to most of us without needing. That's a tailored product. Or you could get a business credit card, again for the same reason. If you need to restock up and you're running low on cash and probably in a week or so you will have money to pay back, then such a product would be ideal for such a need.
Yeah. So another need would be invoice discounting or trade financing. This is specifically if you're in business. Institutions offer flexible credit facilities. Those is banks, SACCOs, and MFIs. Yeah.
Right. So, for example, just to expound on what invoice discounting is for example, if you usually sell on credit, and say your debtors are supposed to pay you on the 30th of every month, but on the 10th of the month you've already sold goods, you don't have cash, but you need cash to take advantage of another opportunity. Instead of, for example, taking 10 digital loans, you could consider the ideal option of taking a trade financing loan from a bank, SACCO, or MFI, that they are going to give you money against the invoice, against the guarantee that your debtors are going to pay you on the 30th. Obviously, they'll have to check your records and your history to approve the loan, but indeed there's a product that is tailored for that specific need. Another example of a use case and the ideal loan type to go for is, for example, a personal emergency. Now, this is where speed and flexibility is very important. For example, you have a patient in hospital and the hospital is demanding for, say, 200, 300,000 to get them admitted. So the biggest factor here is how fast can you get this money so that you can solve this emergency. And some of the ideal products that have seen to work for many emergency situations have been offered by microfinance institutions and fintech lenders.
And also maybe calling a friend.
Indeed, absolutely. Try calling a friend first before thinking of taking a loan.
Yes.
And see if that's
Yeah, we always say that save for a rainy day, have an MMF, have maybe some cash nest or nest egg stash away for the emergency. But sometimes when the emergency strikes, what you have at hand may be not enough to cover. So you would then be forced to take up a loan. And there's no shame for that. So always when you're looking for an emergency funding, sometimes the cost of the loan will not be whatever you're thinking about. You're thinking about how fast you can get the money.
Right.
Yeah, but if you can get unsecured from a friend or a
family,
just start there, then you can proceed to the other types of
lenders who can give you the loan in as fast as you need it.
Yeah.
All right. So now you have an idea on how to match the need for a loan with the right product category. Now we're going to go specifically to talk about logbook loans. The logbook loan is one of the popular product categories that is used in the personal or even business emergencies as one of the use cases for the logbook loan, given the speed with which it happens. So let's go deeper, understand the logbook loan. We're going to discuss also why many Kenyans are taking logbook loans. Do you need a logbook loan, and what are the factors that you would want to consider before deciding on which logbook loan to take? Now, the logbook loan, as the name goes, is a loan type that uses your motor vehicle as the collateral or security. You are able to borrow up to 80% of the for sale value of your vehicle. This means that if your vehicle is valued at 1 million, the for sale value is the value that vehicle can fetch if it is put in the market for a period that is not long enough to allow for sufficient marketing, or what Kenyans call a distressed sale. So this value is less than the actual market value of the car and could be less by even up to 200,000. So if you take that as a rule of thumb for calculating the first sale of the value of the car, if you have a car valued at 1,000,000 shillings, then the first value could be 800,000. Most lenders will lend you up to 80% of that. So if your car is 1,000,000 bob, you will get 80% of 800,000 if the first sale value is 800,000. One thing that happens when you take a logbook loan is the logbook is temporarily transferred into a joint ownership between you and the lender at the NTSA. Once you finish paying back your loan, then you can discharge the loan and the logbook now will come out with only your name. So that's a very brief summary of what it entails, what a logbook loan entails.
So why are logbook loans preferred in emergencies? Or what makes them very attractive? Yeah. So Kenyans use logbook loans to fund quick investments opportunities. So this might be either a personal opportunity or a business opportunity. There's a land on sale, and that for you, you know that is a sale, so you can take up a logbook loan because of the fast processing or the fast turnaround time. Also, if you're a business person, you can take up a business loan, or you can take a logbook loan to put or expand your business. You can take also a logbook loan in emergencies, either personal, majority of the time personal emergencies, or if you're looking to inject some cash in a stalled project, a logbook loan is also an ideal product.
Right.
Yeah.
Some of the other reasons why logbook loans are popular with Kenyans is to also finance a major life change. You have seen people take logbook loans even when they are moving. They needed enough money to move to a new location, and the logbook loan turned out to be the fastest way they could raise this money. During this back to school season, we see lots of applications for logbook loans as people come to the fact that they need to send their children back to school and they don't have that cash in hand. As the example of moving and relocating, as is also featured, and as sometimes we see some businesses taking logbook loans to raise working capital. And working capital is basically the money that you need to facilitate the day-to-day operations of your business, specifically those that are directly tied to making profit. So you would find, say, somebody who owns a bookshop, it's back to school season, and of course they know there's going to be throngs of parents and learners coming to buy books and other stationery to go back to school. And they find that they are short of some popular, maybe set books or whatever. We see somebody like that actually going to take a logbook loan. Some lenders can give logbook loans within 6 hours.
6 hours.
6 hours. They can go and restock. By the time the back to school season is kicking off, they have the stock. It's probably a 2-week window. They have sold the stock, they pay back the loan, especially if they take the loan that allows for early repayment. So logbook loans are, I think, one of the biggest factors is the speed which they can give you the money, and the fact that you can get high amounts as compared to regular personal loans in a short period.
Yeah, so that brings us to why logbook loans are attractive. They're very fast in the processing. Institutions have very fast turnaround time because ideally the car that you're using, that's security enough.
Right.
So, and like where someone's taking an unsecured loan, there's a lot of due diligence that the institution will do.
Right.
But when now you are putting your asset on the line, they'll just look at the assets, confirm it's under your name, then now they'll offer you a certain percentage against the value.
Right.
So for them, they are assured because there will be a change of ownership. As long as the asset is in good condition, they're going to go ahead and process that loan very fast.
Right. And they also put a tracker on
Yeah,
it.
they will put a tracker in this.
So that allows them then to lend you
Yes.
quite quickly because they are guaranteed that in case you try to run, they can recover their money.
Yeah, and they also do the security perfection where before a few years back, all you need to do is just leave.
Deliver the
original logbook, leave it with them, you're given the money, you go. But now they insist on doing security perfection where they just add their name to the logbook.
Right.
So in case, I think they did this because of fraud.
Right.
If I leave my logbook, then I would go and say to NTSA, I've lost my logbook. I go to DCI, do the shoplifting, I have a new logbook. But now when they do the in-charge, the car is...
Then the possibility of fraud is reduced.
It is reduced.
Right.
Also, they are also very attractive because if you own a car, the logbook is under your name. You are guaranteed that you can qualify for financing in some institution. So this is open. Now it opens credits financing to a lot of people. Even if you don't have a history of banking with a lender, as long as you have ownership of the assets, they are able to process the loan.
Right. Yeah. Indeed, which actually takes us to our next topic on why logbook loans are preferred during emergencies. We started by mentioning that one of the most popular use cases for logbook loans is in emergencies. Whatever somebody considered an emergency is an urgent need for cash for whatever purpose. I'm going to discuss some of the reasons that this is the case.
Yeah. We've talked about the fast turnaround time. We've talked about how it's accessible to any car owner. We also have institutions that will accept credit, a bad credit score, less than perfect. They're not very strict on that because at the end of the day, your assets is what they are using as security.
Right.
Logbook loans also typically offer a longer duration, more than, say, a digital loan. And, so you can get...
Or the other emergency loans by banks, which could be 30 days or
30 days, yeah. So with a logbook loan, you can go up to a maximum of 60 months.
Right.
So they have longer duration, so you're able to take up a facility and then put monthly installments within your budget.
Like the example we were talking about, if say a hospital emergency where they need to raise like 200, 300,000 upfront, but the logbook loan allows you to pay it over a longer period of time instead of having to now pay it back in 30 days.
Yeah, you don't have to constrict yourself so back. So you just think about how much you're able to comfortably pay back in a month, then you use that to adjust the duration.
Right.
Yeah.
Also, the other reason is the no usage restriction. So you can, whatever emergency that you are in, you can always get the money through a logbook loan and sort it out.
Yeah.
Also, another major one is that you don't need a co-signer or a guarantor to get the logbook loan. So that also speeds things up. And as long as you own a car, really there's a lender somewhere who can give you money to sort out that emergency.
Yeah.
Also, you can borrow up as much as you can qualify for. So compared to probably the more traditional emergency loans that may be very restrictive, as the value of the logbook loan you can get is tied to the value of your car. So the higher the value of a car, the higher the amount of money that you can get. But you don't have to borrow the maximum, only borrow what you need.
Yeah.
You walk to them and to a lender and they tell you they can give you 500K and you only needed 150,000. It is prudent that you only borrow 150,000 even if you qualify for more. And crucially, which is a good factor during emergencies, is then early repayment is allowed by some lenders.
Yeah.
Such that if you are in an emergency where you needed, let's go back to the same hospital emergency, you borrowed 300,000 and your patient has been treated, and after 2 months you get a deal and you find you can pay back 200,000. Some lenders will allow you to clear your balance and save on all that other interest that you would have paid, making then the logbook loan a potential option when you're in an emergency. If indeed you have a chance to pay back that money and save on the interest, then you can see how some people may find the logbook loan as a good option to take during an emergency. Now, we have some few examples of common logbook use cases, and we're going to run through them. One, you can take a logbook loan if you are. These are answers to the question, when should I take a logbook loan? And we have compiled a list from some of the borrowers that we've interacted with, and the reasons they have chosen to take a logbook loan. One is you need cash fast and in large amounts. Then the logbook loan can actually fulfill this because it can give you high limits and same day disbursement. So if you need a lot of cash and fast, then the logbook loan can be one option to consider, because indeed, as you have said, you can get high limits as high as the value of your car. Obviously, as you have said, 80% of the first sale value of your car. And you'll get lenders giving you this money as long as you qualify within even 6 hours.
Yeah, you can also take up a loan when you need quick cash and you already have an existing loan with another institution, say a traditional commercial bank or a SACCO. Because traditionally, the law stipulates that there's only so much or from your payslip that should go to financing a loan or servicing a loan. So that is for salaried by civil servants, it's usually 2/3. They follow the 2/3 rule. For the private employees or in the private companies, it's half.
Right.
So if I already have a loan with my bank and I need quick money and I cannot qualify for a top-up, I can use my logbook to get a loan from another institution. Yeah.
Indeed.
So because
and when you're making this decision, you have to consider how this will affect your cash flow month over month.
Yes.
So that's why you consider and they consider your ability to repay.
Yeah.
But they are allowing you a chance to get quick financing when you already have another loan and your lender won't give you another.
Yes.
Right. The third one is when you need cash but you have poor credit. I think we've said that many logbook loan lenders, especially microfinance institutions, will consider bad credit. They will look at this reason why you have that score and determine if it's a big enough reason to deny you a loan, when traditional lenders may just flat out deny you that loan.
Yeah. So when you have a very urgent emergency, that is also something we discussed the first time.
Mm-hmm.
Yeah, the fast turnaround time, logbook loans is an ideal.
Right. Indeed, just the fact that you need the fastest amount possible, and this is in your assessment the most important factor you're considering at the point, then the logbook loan comes in as one of the obvious choices in that scenario.
Yeah.
The other reason tied to credit is you need a loan but have no credit history. So you realize, and Hilda can expound on this, that your credit history is an important factor when getting loans, especially with traditional lenders. But with some logbook loan lenders, especially microfinance institutions, if you do not need any prior history with them, because you don't even need to open an account with them.
Yeah.
So the fact that you have never borrowed again does not mean you can't get a 500K loan if you go the logbook loan way.
Yeah, that's true.
And the last one is when you need a short-term loan and you can repay quickly. We said if one of the reasons Kenyans choose logbook loans during an emergency is if there's the ability to pay early. Early repayment is allowed and you can save on interest. So if, for example, you have seen a shamba, which is a popular purchase by Kenyans, is a distressed sale, for example. So you can snap up that plot for, let's say, a 40% discount. Somebody is in dire need of money and they are selling their shamba and you don't have the cash right away, you can take a logbook loan, buy that shamba or buy that discounted asset that you are getting for a steal. And once your monies come in, you can repay the lender, save on the interest that you'd have paid, and now you have won twice.
Okay. So yeah, now that we've talked about logbook loans and how they work, we're going to talk about on how to compare the logbook loans. We have hundreds of options available in the current market. So it would be now you've chosen logbook loan as the loan category. How do you then find the lender that's best suited for you? So there are some factors that you need to consider or that you use to compare logbook loans.
Options.
Yeah.
Right. Indeed, we have been saying there are many lenders who can give you a logbook loans, from banks to SACCOs to microfinance banks and microfinance institutions. And all these have multiple products. Ideally, you are looking for the logbook loan that is best suited to your circumstance. There is no such thing as the best one. The best one is the one that best fits into your circumstances.
Yeah.
One of the most important factors to consider when comparing the options you have is fees.
Yes.
And I'll let Hilda explain how fees work.
So when for any credit facility, there will be some fees associated with it. These are the processing fees, the application fees. So for the specific logbook loan, there's valuation fee. So this institution will determine, or depending on the institution, you either pay for some of these fees upfront, or the fees are deducted from the loan amount, or the fees are added onto the loan amount. So if I am in an emergency and a lender requires me to raise an upfront fee of 3,000, maybe I don't have that 3,000.
Right.
So I'll be looking for an institution that does not require me to raise any amount beforehand.
Right.
Or maybe I'm looking for 100,000. I need an institution that will not deduct the fees and give me less 100,000.
Right. Because that will not solve your problem.
It will not solve my problem. So the fees are very important, and how they're structured is equally as important.
Right.
Yeah.
Another important factor which most people would say is the most important is the interest rate.
Yes. Well, interest rates and fees, they go hand in hand, because we'll talk about this later. Interest rates and fees contribute to what we refer to as the total cost of credit. So the interest rate is ideally what lenders just advertise.
Yeah.
They will say we give loans from as low as 1.9%. Yeah. So if you do that, you do a month, maybe that will translate to 24% annually.
Right.
But what if I add to the fees? What happens to the total cost of the loan?
Right.
So you might find that interest alone will attribute to half the cost of the loan. So interest is very important. Ideally, yes, you look at the lender that's going to give you the lowest interest, but also be very keen on the fees that the lender is also charging you.
Right.
Yeah.
The other important factor when you're considering different logbook lenders is the percentage finance.
So this then, percentage finance will now tie to how much you're going to get. If I'm looking for 100%, because I might qualify for that.
Right.
But if my car is worth 2 million and I need 1 point something, I'll go for the lender that gives the highest percentage financing.
And what are the ranges in terms of percentage finance?
So in the market right now, we have up to 80%.
Right.
So the up to is very key, because then this is tied down to the car make and model.
Right.
So when institutions offer 80%, the car type or the car make and model that will get 80% financing is a car that's very attractive in the Kenyan market.
Right.
A car that's very easy for them to sell.
Yeah.
So definitely Toyotas get very high percentage financing compared to, say, other European brands. So in the Kenyan market, the highest percentage financing is 80%, but depending on the year and the year of manufacture and the make and model, some institution will offer you 20%. Especially if it's an older car, you can only maybe get 20% of the for sale value.
Right. So the fees, the percentage finance, and the interest are some of the key factors when comparing logbook loans. But then there are also terms and conditions. We're going to come to the question on the processing fee in a moment. Let us first talk about the terms and conditions. And what is one of the most important things that you need to have in your car?
So terms and conditions. First, across the board, institutions are going to value your car, and once you've signed the loan offer, they will install a tracker to the car. Then they will put the car under joint ownership. But before you sign that loan offer, there are a few things that you need to be aware of. And one is, like I mentioned, the fees structure. Will the fees be deducted or capitalized? If the fees are deducted, that would mean I get less amount. But if they're capitalized, that would mean they earn interest. So my total cost of the loan will be high.
Right.
Another term and condition is on insurance. Will the lender require my car to be comprehensively insured? What if currently I have third party? So does that mean I have to source for funds elsewhere to put comprehensive? Or if they offer me IPF, does that then translate to a high total cost of the loan?
What is IPF?
IPF is insurance premium financing, where an institution will get you an insurance cover and then you repay the institution either in installments over, say, 3 months or 9 months. Yeah.
So if you're taking a loan and I have that party insurance, and the lender that has given me the amount I want requires me to have comprehensive insurance, and I don't have the money to pay for the comprehensive insurance, what happens?
So at that point, because they've already done valuation, they then just give you a quotation of insurance. And most lenders have specific underwriters, insurance underwriters they work with, but others will give you an option to choose the insurance company. Then they will pay for the premiums. Your car is comprehensively covered. Then the cost of that loan is either capitalized. That means if I took 100, my insurance premium was 20,000. My loan is now on 20,000.
Right.
Some lenders will, however, deduct the premium from the loan.
So I receive less 20,000.
You receive 80. So, but IPF is available across majority of the lenders.
Right.
Okay, so another important term and condition, terms and conditions, they matter. It's whether the lender will allow you to make an early repayment or not. This is especially very important if you are taking the loan for a business need and you are sure that the investment will bring bring in money in a few months, so you will be able to repay.
Right.
If I'm taking a loan to supply something to a school and I know they'll pay me after 90 days, I know I can repay the loan in 90 days. So I need to be sure if I take the loan for the institution.
If you take like a loan for 1 year.
For 1 year, yes, because you never know.
Yeah.
So if I take it for 1 year, can I repay the loan after my invoice is paid?
Right.
And if I can, will they charge me?
Right. So do some lenders charge if you pay early?
Some lenders charge, unfortunately. Some lenders will charge you a fee of either a standard fee or sometimes it's a percentage. Some lenders will require you to pay a certain percentage of the interest that you want to pay.
Right.
If the interest on the loan was 20,000, some may require you to pay 50% interest and the outstanding principal.
Right.
And some lenders do not allow early repayment. So that is something you need to be keen on when you're taking up before you sign.
Which takes us back to the matching your loan with the need. So if you need, indeed you think you can pay the loan early, if you want to sign with, to take a loan with a lender who allows you to pay early with no extra cost.
Yeah. And another term we'll go to is the late fees. So lenders will penalize you if you're late to make other payments. Some will charge you daily on the installment amount. Some will charge you monthly. So it is, you need to be aware of the repayment structure or the penalty structure should you be late.
Before you sign, because indeed the reason why you want to know this is because things may happen down the road that may make it difficult for you to pay.
Control, And even if you are late for a day, you need to be aware whether the lender is humane enough to offer you an extension, or they'll start charging you, penalizing you the very first day.
Right.
So,
and this is usually in the letter of the.
It is in the fine print.
Indeed.
So, in the fine print.
So if I was going to say you need to discuss these things before you sign, but you also need to see that they are in the loan contract. Right?
Yeah, they are in the loan contract. So you actually need. I know that sometimes the need is very urgent, so you may not take time to go through all the fine print, terms and conditions apply. I, for myself, when I'm signing in somewhere, I just go to accept all terms and conditions. But when you do that on a loan, there are some wild consequences on that. So make sure you read the fine print when you're taking up a credit facility. And also the last one I'll talk to is the repossession policy tied on to the late fees. How long does the lender take before they repossess the car?
Right. This is also outlined in the...
It should be. Majority of the institutions outline this, but others might not. But it's something that they will tell you about when you ask. So try and learn about this lender. How long should I be late? Because sometimes things cannot be controlled. Emergencies happen, If you are late, when do they come for my assets?
Exactly. Because this might impact your ability actually to recover from a setback. Right?
So you need to know if I am aware I'm going to be late. What happens?
Right.
Lenders, some offer you a 7-day extension or a grace period. My due date is today. They tell me, okay, we'll push your due date to next Friday.
Right.
Some lenders. So you need to know, is your lender going to allow you for an extension? Yes, you never take up a facility thinking that, okay, I'm going to be default, but emergencies happen. So you choose a lender that's going to be humane or have processes that will support you through the loan.
Right. I think the other term is the interest structure.
Yes. So this is flat rate or reducing balance. Reducing balance is where interest is charged on the outstanding loan principal. So the interest charged reduces on a monthly because your principal has reduced with every monthly repayment. Flat rate is charged on the principal you borrowed. So if you borrowed 100,000, 10 months down the line, you'll be paying interest on the 100,000.
So this impacts the total
It impacts the total cost of the loan. So reducing balance, the interest or the total cost of the loan is usually lower. So if a lender offers reducing balance, that's a plus.
Indeed. I think one of our viewers was asking about the processing fees for logbook loans, how maybe the range and maybe any other fees that we haven't mentioned.
So when it comes to loan processing, the first one, like I mentioned, is valuation, because usually the lender will use a third party. Most of the lenders will use third party. So that is a fee that if the institution is actually does not have maybe an agreement with the valuer, you'll be required to pay for that upfront.
Right.
But if institutions have in-house valuers, you may not pay for valuation. So that's a standard fee. So it's either you pay for it upfront, it's either deducted, or it's either capitalized. Another standard fee across the board is the processing fee or the application fee. However, the percentage differs. We have as low as 2.5% of principal. we have as high as 10% of principal. This is why we mentioned earlier that interest rate is not the only thing you need to look out for. Because if a lender is charging me an interest of 3% and the processing fee is only say 4% of principal, and another lender is charging me 2.5%, but the processing fee is 7% of principal, I will obviously should go to the lender that is charging when I combine the fees.
Right. Yeah, I think I'd like to just talk about that a little as we go into fees.
Yes.
How to actually, briefly, how to find the actual cost of your loan.
Actual cost of the loan, yes. We'll walk into that. Then, okay, we'll go to the actual cost of the loan or the total cost of the loan after the fees. So the processing fee, the range currently, as we have in the Kenyan market, I would say it's between 2.5% to 10% of principal. How to find the total cost of the loan? When you take a loan and the interest rate is 10%, your total cost of the loan will not be, if I've borrowed 100, the total cost will not be 110,000. I will have to add the cost of the fees. If the processing fee was 2.5, that's 2,500. Maybe they had a membership fee of 1%, that's 1,000. They have legal of 0.5%, that's another 500. So finding the cost of the loan, you combine all the fees and the interest rates and then the principal. So that's the total cost of the loan. How much are you paying back the lender? If I've borrowed 100, how much will I pay the lender back? If I pay 150, the total cost of the loan was 150.
Right.
Yeah.
Indeed, and this is to say then it is possible for a lender who advertises their interest rate to be 2% to actually be more expensive than the lender whose interest rate is 3.5%.
Yes.
If you factor in the fees.
Yes.
And that is probably a very important thing to know about when you're thinking about taking a logbook loan. Pay attention to the fees.
And this comes to, we have, people will say they're hidden fees, okay? They were hidden fees because I went to a lender and I asked, what's the interest? I was told 5%. And maybe I will ask, what's the processing fee? I was told 2.5%. But I was not told, or I did not ask about other fees. Maybe there was membership fee, registration fee, disbursement fee, tracker installation fee. All these fees were not hidden. You just maybe were not aware or did not ask about of them. So you apply for money and you get 20,000 less, and you're wondering, okay, where has the money gone? What's this fees? Or I apply for a loan, I'm expecting, because the interest rate is 10%, I'm maybe expecting to pay this. But because of these fees, especially, say for logbook loan, because of the tracker, lenders will charge a monthly fee on that tracker.
Right.
So which then increases.
It could be like 1,700 a month?
At least 1,700 a month, as high as 2,000 a month.
Right.
So in my principal, or what I'm paying back on my loan, I was maybe expecting I'll be paying back 5,000, but because I'm paying back tracker fee of 1,800 every month, I am paying back loan monitoring fee of 1,000 every month. I'm now paying back almost 8,000.
Exactly.
Yeah. So the fees are very, very important when it comes to any type of loan.
And in our review of some logbook loan products, you've seen some fees taking up as much as 50%.
50%.
Indeed.
50% of the cost of the loan.
Right. So what Hilda has been describing, finding the total cost of the loan, is actually how on money254.co.ke we help you to compare the loan products based on the actual cost, not just the marketed cost. We have talked about the fact that in some loans the fees could take as much as 50% of the loan cost. And I'm going to let Hilda, as we are wrapping up the last 3 minutes of this conversation, to talk to us about how to use money254.co.ke logbook loans quotes web app to compare logbook loans side by side.
Okay, thank you, Eric. So on money254.co.ke, when you come onto, we ask a specific number of questions to try and match the lender that's best suited to your need. The questions that we are going to ask is the amount that you're looking for, and also the make and model of the car and the year of manufacture. So this is because lenders are very specific on the type of cars they're going to finance and the year of manufacture they're going to accept. Year of manufacture is tied back to can the car qualify for comprehensive insurance. So we ask you how much you're borrowing, how much you want to borrow, what is the type of car you own, what's the year of manufacture, and what's the make and model. We then show you a list of institutions that can finance you, that amount of money, and a breakdown of the total of the fees that you either be needed to pay upfront, of the monthly repayment amount, and also the total cost of the loan. And you can use our compare button to compare products side by side. And remember, there is no bad loan as long as you can meet your repayments. So yes, matching your monthly budget to the amounts that you're looking for is key in repaying or easy payments of the loan, or easing the burden of the loan, because every loan is a burden. So if you can meet the repayments easily, it becomes an easier burden.
Exactly, exactly. As long as you match the loan with your loan need in the right category,
yes,
and you have a good ability to repay the loan, you have assessed that, then loans and financing can actually help increase your net worth and your quality of life. So as long as you're funding things that are growth oriented and not necessarily consumption.
Yeah.
Thank you very much for joining us today. We are very happy that you have given us your time. We hope to see you again next week.